Today, let's ask the question, what is fiscal policy? Fiscal policy is a critical component of a government's economic management strategy, encompassing the use of government spending and taxation to influence the economy. Governments implement fiscal policies with the goal of achieving specific economic objectives, such as promoting economic growth, stabilizing inflation, or addressing unemployment. The two primary tools of fiscal policy are government spending and taxation. When a government increases its spending on infrastructure projects, social programs, or other initiatives, it can stimulate economic activity. This increase in demand often leads to job creation, increased production, and overall economic growth. On the other hand, reducing government spending can have a contradictory effect, slowing down the economic activity of a nation. Taxation is another lever of fiscal policy. Governments can influence economic behavior and income distribution by adjusting tax rates. A reduction in taxes provides individuals and businesses with more disposable income, potentially boosting spending and investment. Conversely, tax hikes can be used to curb inflationary pressures, reducing income inequality, or fund government initiatives. Countercyclical fiscal policies aim to smooth out economic fluctuations. During economic downturns, governments may increase spending or cut taxes to stimulate growth and job creation. Conversely, during periods of higher inflation or economic overheating, they may reduce spending or raise taxes to cool down the economy and control inflation. Fiscal policy is closely intertwined with monetary policy, which involves the management of money supply and interest rates by central banks. Together, these policies contribute to overall economic stability and sustainable growth. However, effective fiscal policy requires careful consideration and coordination. Policymakers must strike a balance between stimulating economic activity and maintaining financial responsibility to avoid excessive budget deficits. The success of fiscal policy also depends on factors such as the responsiveness of consumers and businesses to changes in government measures. In times of economic crisis like the global financial downturn of 2008 or the COVID-19 pandemic, fiscal policy often becomes a primary tool for governments to stabilize and revitalize their economies. Stimulus packages, tax relief, and targeted spending programs are common fiscal responses during such challenging periods. In conclusion, fiscal policy is a potent instrument for governments to influence economic conditions, drive growth, and address specific challenges that it might face. Its effectiveness relies on a nuanced understanding of economic dynamics, prudent decision-making, and an ability to adapt to ever-evolving economic circumstances. Please note, while we may discuss finance, investing, and money on this channel, this video should not be considered financial advice. When investing or making plans for your own financial security, please seek the guidance of a licensed professional capable of making more informed decisions. If you make a financial life decision based upon the content of this video or channel, then please do so at your own volition and at your own risk. This channel and the people associated with it should not be held liable for your investment choices.